Hello and welcome. In this final Chapter 15 lecture video, I'm going to be talking about reporting for influential investments and also reporting for securities with controlling influence. So when we talk about influential investments, we're talking about equity securities, not debt securities, but equity securities. So purchasing stock in a company, equity security. Now, what do we mean by significant influence? It means that the investor has a lot of influence over the investee. So what that's saying is that if we're a company, if we go back to that example, some of the earlier lecture videos, where Music City could have been investing in Dell. Let's say that Music City invests heavily in Dell, buys, for example, 22% of the outstanding shares of stock. That would mean that Music City has a significant influence over Dell. Okay, because remember, stock is ownership. Okay, so when we're talking about significant influence, we're saying an investor owns 20% or more, but not 50%. You get to that rate of 50%, then we're talking about controlling influence, okay, of a company's voting stock. So what we actually have to do is we're going to use the equity method of accounting. Now, we're not going to go into too much detail on this, but we will do some basic journal entries for purchasing shares of stock with influential investments, okay? And then also disposing of those as well. So, just like what we talked about before, in terms of some of the other examples we've done, we recorded at cost. So if we look at this example, assume Micron Company records purchase of 3,000 shares, which is 30% of Star Company's outstanding common stock, voting stock. Okay, at a total cost of $70,560. Come over here on 1/1. We record this at cost. The cost is this. That's what we recorded at. So we say our long-term investments. Star, that's the company that we're buying the stock in, $70,560 debit, and then we credit cash for $70,560. We have to buy it with cash. Okay? So when we look over here, continuing on, we can say the investees, Star's earnings increase both its own net assets and then the claim of the investor. Okay, so what that's saying, right, earnings, as we know, any income is closed out to capital, to equity, or in this case, if it's a corporation, retained earnings. It's going to go into retained earnings. So that increases their equity, but we're saying because there's influential this is an influential investment that also raises Micron's, okay, the claim of Micron's on the investee Star's net assets on their equity. So what we're saying right over here is when the investee reports its earnings, when Star reports its earnings, right, the investor, Micron, is going to record its share of earnings in its own investment account. So it's recording its share of Star's earnings. That's what we're saying right here. So if we look at this example, let's look at that. So assume that Star reports net income of $20,000, and then Micron has 30% of that voting stock. So you can come over here, we could say there's their income, $20,000, and Micron is 30%, so they get $6,000. Now this is not in the form of a dividend, okay? This is the form, it increases their claim on Star's equity. So what we would do over here is we would debit our long-term investments, increase that investment in Star, the value of that investment. Because remember, this is when we bought it, we debited it. Now we're coming over here, Star has $20,000 net income. We have 30% share, so our investment in Star is also gone up by 30% of that $20,000 by $6,000. Okay, and then we would credit earnings from long-term investments for $6,000. And so if we look at this bullet point, let's talk about that. So it says the debit right over here reflects Micron's equity in Star, and that has increased because Star's equity also increased, and Star's equity increased because they had net income. And remember, when we talk about closing journal entries, we would close our revenues and expenses to income summary, and then income summary into our capital account, in this case into, because it's a corporation, into retained earnings. Okay, so basically that increase in retained earnings because of this income is increasing Star's equity. Micron gets 30% of that, so the $6,000. Okay. Now this earnings from long-term investment, that's a temporary account, which is going to be closed out to income summary, and it would be reported on Micron's net income statement, on their income statement. Okay. On the other hand, if Star incurs a net loss instead of profit, instead of net income, the investor records its share of the loss and then credits the investment account. So we would have loss from long-term investments, and then we would credit our long-term investment account. Okay, and then that would also be closed out to income summary. Okay, received of dividends would not be revenue. Okay, because the investor has already recorded its share of the investee's earnings right over here. Okay, so let's look at receiving dividends. So cash dividends received by investor are simply converting one asset to another. Dividends increase cash, but reduce the balance of their investment account. So it's not dividend revenue because there's an influential. Okay, we have an influential influence here. So in this case, we have over here, so let's say they paid $10,000 dividends on its outstanding common stock. Micron gets 30%. Why 30%? Because they bought the initial 30% of their outstanding common stock. So they're entitled to 30% of those cash dividends. We take our 10,000 times our 0.3, gives us our $3,000. Now in this journal entry, we would debit cash, $3,000. And then rather than recording dividend revenue, it's not dividend revenue because it's an influential influence. In this case, what we would do is we would reduce the long-term investments account Star by the amount of the dividends that we received, and that's what we're saying right over here. Cash dividends received by Micron are a conversion of one asset to another. Basically, we're moving it into cash and moving it out of our long-term investments Star right there. Okay. So when we continue on, let's talk about really at a very high level investments in securities with controlling influence. Okay, that'd be a situation, if we look at the Micron and Star example, where Micron owns more than 50% of Star's voting stock. So there's a controlling influence. They can tell Star what to do because they own the majority of the stock. Okay, so in that situation, we have to use our equity method with consolidation. So basically what we need to know from this standpoint with controlling influence is that it's going to, our financial statements will be prepared as if one company. Okay? As if one company, that they're all together. Okay? And so that's what we say down here. And that would be coming down into comprehensive income. Okay? All right, so that's basically what I wanted to talk about with controlling influence. I want you to know what we mean by controlling influence, that it's more than 50% of that stock, okay? And that basically means that they can tell, in that case of Micron and Star, they can tell Star what to do. And we would use that equity method with consolidation without going into a whole lot of technical details. Just think of it, one company, consolidating the financial statements, okay? All right, that concludes Chapter 15 notes. Thank you so much.